Madam, very good afternoon. Smriti, madam, very good afternoon.
Good afternoon, everyone. A very warm welcome to our session today on the Investor Awareness Program and knowing about the role of agri-commodities market in the current Indian economy and how you can participate in the agri-commodity derivative segment, which is with the various options which are present and available. So I would like to invite Mr. Dr. K. Prabhakaran, who is an expert speaker for our session today. So he is going to talk about the various kind of opportunities which are there in the market and how you can participate and be a part of agri-commodity derivative ecosystem and make the most out of it with the kind of awareness that we are trying to spread across. For any queries, for any questions, please feel free to write in the chat box. We will take up all your questions at the end of the session. So please feel free to connect and ask any kind of question that comes up. So just to give a brief as to role of agri commodities, we have seen that agriculture is the backbone of the Indian economy. Indian economy wherein the GDP plays a major role. So if you'll see in 2019-20 GDP, the contribution of agri segment was around 17.8%.
Madam, your voice is not audible. Kindly check it your mic.
Whereas in the year 2021, it increased the current agri commodity market or in more than if we see and if we see that more than 70% of our kind of spends were so because agriculture is something which provides you the food security and the raw material which is required for the industrialization. So growth in the market is very critical and we should understand about the opportunities which are there. So now I would like to invite Mr. Dr. K. Prabhakaran to present his presentation in front of all of us.
Yeah, thank you, madam. My voice is audible?
Yes, sir.
Screen is visible, madam?
Yes, sir.
Yeah, thank you, madam. Yeah, a very warm good evening to everyone. My special thanks to NCDX team for giving the opportunity to me. So I'm a empaneled resource person for SEBI, NCDX, and NCFE for conducted investor education and financial education more than 700 through Pan India. So it is a great opportunity for conducting for you people. So this is for awareness program, investor education program. The topic role of agri commodity derivatives in Indian economy. This is sponsored by NCDX under the objective of SEBI. You know SEBI objective. The first primary objective is investor protection. Second objective, promote and develop the securities market like this kind of programs. Third one, to regulate the securities market. So you know SEBI. SEBI was started in 1992. Most of the investors are not are aware about the SEBI. And the SEBI before 2015, the commodity markets are regulated by FMC, Forward Market Commission. At present, SEBI regulate for commodity market also. So SEBI regulates stock market, commodity, currency trading, and mutual fund operations also regulated by SEBI. Okay, and so this program is for NCDX. So, at present in India, exclusive commodity exchanges, three exchanges available. One is called NCDX, another one MCX, Multi Commodity Exchange, another one India Commodity Derivative Exchange. It was before National Commodity Derivative Exchange. Okay. So, first we're going to discuss about overview of commodity derivative ecosystem. So, basically, first we should know, most of them aware about for commodities. Somebody said not aware about commodity. So commodity is nothing but we are using the product. Say for example, equity or mutual fund or whatever it may be, we can't see. We can't see the product, we can't touch the product. But commodity, we can see the product, we can touch the product. That is called commodity. Okay. Say for example, commodity means every day we are using product in our home, rice, wheat, and then spices and coconut. So everything should be comes under the agri commodities. Chenna, soya, pepper, cotton, jute, like that. These are all for agri commodities. And then metal commodities like copper, nickel, zinc, aluminum, this kind of metal commodities. And then for precious metals like gold, silver, platinum, like that. These are all for precious metals. And then for energy commodities like crude oil, natural gas, this kind of, these are all for we are using regularly using the product. So generally, so these commodity prices, so maybe it will going to increase 20%, maybe it will come down to 20% minus, plus or minus, maximum fluctuation 20 or 30%. So depending on the season basis only the commodity prices are fluctuated. Okay. But coming to the commodity exchanges, evaluation of commodity exchanges, the 19th century commodity trade started through Bombay Cotton Trade Association, only for trading and cotton product only. After that, oil seed and jute started from 1910 to 1930, and FMC established 1953 for regulating the commodity transactions. And after the 20th century, the government of India established a list of commodities for derivative trading. Before, not possible for derivative. After that, 2001, commodity derivative products also trade. It's government of India given for permission. After that, 2003 for first commodity exchange in India, National Multi Commodity Exchange. At present, the name is India Commodity Derivative Exchange. After that, started MCX, Multi Commodity Exchange, and then NCDEX. And note it, the NCDEX only exclusive for agriculture commodity derivative products are traded. So the total 24 products are traded. Total only 24 commodity derivative products. And out of 24, 23 products are agri products, agri-based product commodities. One is steel. So you can go for this MCX. Most of the commodities are trading for metal as well as natural resources. So these two type of commodities are traded in MCX. At NCDX, only more than 90% volume, especially for agriculture commodity derivative products, are traded in NCDX only. Metals and other precious metals and natural resources trading in MCX, Multi Commodity Exchange. So next we can see the present regulator of commodity derivative markets, SEBI. From September 2015 onwards, SEBI regulate commodity derivative trading also, not for commodity spot market. Kindly note it. Only commodity derivative products, metal commodity, agriculture commodities, and then natural resources commodity derivative products are regulated by SEBI, not for spot market. You know the difference between spot market and derivative product. The spot market means, so real investors, they are going to pay 100% money, they are going to buy a product and they can use the product. But derivative products, we are entering into contract. We are entering into contract. We will discuss about what is derivatives and everything. We will discuss. Okay. And what are the structure of commodity exchanges in India? I think screen is visible, madam.
Yes, sir, your screen is visible.
Okay. Thank you, madam. Yeah.
But if you're moving, it's not moving.
Yeah,
I mean,
that's why I'm
scroll down,
asking.
it's not
Yeah.
scrolling.
That's why I'm asking, madam. Okay, if not moving, kindly let me know. Yeah, structure of commodity exchanges in India. How it's moving?
Yes, sir. Now it is, sir. Please
Okay,
continue.
okay, thank you, madam. So, commodity exchanges under the Ministry of Finance or Department of Economic Affairs, it is one of the um, major role of financial functions of Ministry of Finance. You know the current Ministry of Finance, okay? And it is comes under the SEBI, Securities and Exchange Board of India, and SEBI regulate all securities market, stock market, mutual fund, commodity trading, as well as currency trading also. So at present, how many national exchanges commodity products are traded means, you know very well, NCDX, National Commodity Derivative Exchange. At present, 24 products are traded. Out of 24, 23 for agri product, one is steel, and MCX at present more than 20 products, most of them for metal commodities as well as precious metal and natural resources. And ICEX, India Commodity Exchange, that also traded agriculture commodity as well as metal also. And NSC, you know NSC, National Stock Exchange. So now NSC also started commodity trading from 2018 onwards. At present, nearly 5 to 6 commodities are traded. Okay, and BSC also now trading started for commodity trading. So at present, 5 to 10 commodities are traded in BSC also. This is a structure of commodity exchanges in India. And what are the working up the steps with strong regulatory support? So before 2015 and after 2015, tremendous changes in commodity derivative markets. So at present, most of the general public, most of the traders are aware about for commodity trading. Previously, they are trading equity derivative and currency. So at present,
Your
most
voice
of
is
them,
not clear. Can you check it
yeah,
once?
yeah.
Your voice is not clear.
Madam, it's okay, madam.
Yes, sir. Your voice is clear.
Sir, you can check your internet, sir. Yeah. So first step for working up September 2015 when SEBI regulation started. So after that, June 2017, SEBI permit option commodity derivative segments.
So your slide is not visible.
Not moving. Now it's okay, madam.
Now it is okay. Yes,
Okay,
sir.
okay. So SEBI permits option commodity derivative segment. Before, only future products are traded before June 2017. After that, option products also traded, and SEBI permit category of third AF categories also. And September 2017, SEBI permit integration of equity and commodity arms of booking as arms of broking, and banks subsidiaries allowed to distribute commodity derivative products also. And September 2018, FPS, foreign portfolio investors, permit to hedge facilities. So hedging, you know very well, it is a risk minimization tool. It also accepted from September 2018. And March 2019, mutual funds and PMS, portfolio management services, have been allowed to, particularly on commodity derivatives. And June 2019, commodity indices have been allowed to be traded. Commodity indices like that, agri indices. I will show you the, yes, agri index. Okay. Yeah, tell me, madam.
नहीं, मैंने तो बताया, मैंने तो कन्वे करा था वंदना मैम को और गुरवी को.
Madam, yeah, can you talk to English, madam? I don't know Hindi.
नहीं, मैंने नहीं सजेस्ट करा, मेरे को वंदना मैम.
Okay. I think class talking. So now we discuss about the difference between spot market and future market. So we are talking about for role of agriculture commodity. First, what is derivative? What is spot market? First, we should know. Spot market means it is a like investor. So we are going to invest 100% money. Say for example, if you want to buy 100 kg of rice, so at present, what is the current market price? 50 rupee per kg. 100 into 50, how much? 5,000 rupee we should pay. We can take the material, we can take the rice. That is called spot market. But future markets, derivatives are nothing but it is a contract. Derivatives are, it is a contract traded between two parties, which is facilitated by the exchange platform. Say for example, simply what is derivatives? Derivative is a derived product. It is a derivative is a derived product. It is from it is an underlying asset, not an asset. Kindly note it. Say for example, simple example for spot market and derivative. Simply example, another differences. Assets and underlying asset. Asset means real owner of the property. Say for example, you take for two persons. One person from myself and one person is Shruti madam. So Shruti madam having for own house. Shruti madam having for own house. The value of own house may be 50 lakhs or 60 lakhs. So if she is staying in own house, no need to pay monthly rental. Okay, no need to do for any agreement. See, having for own house, that is called assets. Say for example, underlying asset, I'm having for rental house. I'm staying in rental house. So every month I should pay the rent monthly basis, 10,000 rupee or 15,000 rupee. Okay, but agreement between myself and building owner, lessor and lessee, what mentioned? So every month how much I'm going to pay the rent, maintenance charges and other charges also, and how much advance, everything they have to mention. So that is called underlying asset. So that house I can utilize, I can use the asset, I use the house, but I'm not a real owner of the house. So that is called underlying assets. So that is called we are telling. Another example, what is derivatives? So every day, I think more options available. Dear participants, you can unmute and tell me. Every day morning, wake up time maybe 5 o'clock or maybe 6 o'clock or maybe 7 o'clock, depending on the person. Okay, but I'm telling, I wake up only 6:30 to 7 o'clock. Okay, somebody said wake up 6 o'clock. When we going to take first food, which one we are going to take? When wake up time, which food we are going to take? Anyone tell me? Dear participants, yeah, Hari sir. Yeah, Hari
Last
sir, tell
person,
me.
sir.
Last person.
Yeah.
No, no, sir. I'm asking. So when you wake up, which kind of food we are taken first initially? Like
Tea or
tiffin.
coffee?
Yeah, very good. Tea or coffee. Like, okay, so we are taken from example for coffee. So coffee or tea or boost or Horlicks, whatever it may be, without milk we can't prepare. Without milk we can't prepare coffee or tea, right? So this is a real example for derivatives. Say for example, what are the products we can make from milk? Anyone? What are the product we can make from milk? Anyone tell me? The participants, quick fast.
Agriculture?
I don't know. What are the, yeah, no, what are the products made from milk? Tea, coffee, like that. Ghee,
Milk powder.
butter. Yeah, milk powder. Okay, fine. And then curd,
So like
that.
butter, cheese,
Yeah,
cream.
butter, cheese, right? Okay, fine. Say for example, milk price at present 1 liter 60 rupee. Milk price 1 liter 60 rupee. At present, curd, 1 cup of curd is 20 rupee. If the milk price is going to increase 75 rupee, what about the impact of curd price? It will going to increase or decrease? Anyone tell me?
Increase, sir.
Increase, yes, that is called derivative. So derivative is a derived from, value is derived from another product. Okay, another example. Every day we are using coconut. Am I right? Without coconut, we can't do anything in our home. Yes or no? Say for example, tiffin, chutney, and then for coconut, milk and coconut using for some vegetables like that. Okay, we are using for some sweets also, right? So at present, you can see one coconut price is now 25 rupee. Okay, but at present, coconut oil we can take 1 liter price is now 300 rupees. The coconut price will increase to 35, 25 to 35. What about the impact of coconut oil price?
This is also increased, sir.
It also increased. Yes, correct. That is called derivatives. Derivative is a derived product or a contract. So I am now given example for product. So what about contract? Means the agreement between two parties. Agreement between two parties and myself and exchanges. Myself and exchanges, or myself and another person. So the contract is nothing but agreement between two parties. Okay, that is called derivatives. Now you can understand. So derivative products are 4 types of derivative available. Okay, kindly note it. Some are known, some are not known. One is future, another one option. Third one swap, fourth one forward. So 4 types of derivative product available. So first I'm going to discuss about for swap and forward contract. So swap and forward contract, the agreement between the two parties, maybe you and me, or maybe you and foreigner, you and some other persons also. So that is comes under the OTC, over the counter market. And coming to the future and options, future and option, both the products are traded in exchanges, maybe stock exchange, maybe commodity exchange, maybe currency, maybe interest rate. So these are all commodity derivative products available in India. 4 derivative commodities are traded in India. First one, commodity derivative. Second one, currency derivative. Third one, equity derivative. Fourth one, interest rate derivatives. So these are all we are telling about agreement between the exchanges, not for um, the person. Okay, so that is called forward and swap. Okay, but the forward contracts are customized depending on the demand and supply of the buyer and seller. But future and option contracts are standardized contract. So exchange will be fixed by the contract lot size. Say for example, simply okay. So I ask on basic example, especially equity derivative. So everyone know about Nifty, right? So how to calculate Nifty? Anyone tell me how they calculate Nifty? Anyone?
Sir, Nifty is basically a benchmark. It could be
Benchmark
basically,
index of NSE. Okay, sir. Congratulations. Thank you. How they going to calculate Nifty?
sir,
Any
like
parameter?
analyzing the top 50
Very
companies.
good, very good. Yeah, top 50 companies of NSE based on the market capitalization. Very good. Congratulations. But that is called spot Nifty. So Nifty future also available. So Nifty future contract available in NSE. So that also contract every 3 months contract available. Normally this month, October month contract available, November month contract, December month, 3-month contract available. This contract will be closed on every month of last Thursday. That is called equity derivative contract. Okay. Coming to this commodity derivatives, say it's at present equity derivative, 4 products are available: stock futures, stock options, index future, index option. 4 products available, and commodity also. Uh, Commodity futures and options available. What are the commodities traded in NCDX? I told you before, 24 commodities. Out of 24, 23 commodities are agricultural commodities, and one is steel. Okay, and interest rate derivatives also available in trading in NSE, and currency derivatives also available in India. 4 currencies are available, like that. US dollar, euro, pound, and 4 currencies are available in India. So these are all derivatives. So what are the difference between spot market and derivative? Spot market, we should pay 100% money. We are real owner of the property. But derivative products are we are enter into contract. We are not real owner. We can enjoy the profit. Say for example, we are enter into turmeric. Say for example, today turmeric price is 1 metric ton 8,000 rupee. You can assume 1 metric ton turmeric price is 8,000 rupee. Okay, but you are expecting turmeric, that also contract date mentioned. Normally the turmeric will every month contract available. Every month of you can assume 15th. So this month contract 15th, October 15th will close means next month contract available November 15th. So what is contract? Agreement between two parties. You and exchange. That is called future and option contracts. I'm going to explain future and option next finally. So this is called derivatives. Okay. So what are the types of the derivatives I told you? But next, what about future and options? So what about future and option? Futures is nothing but agreement between exchanges. Future products are traded in exchanges only, not for individual. It is a standardized contract. Okay. Normally, future contracts are available. Equity also I told you. Commodity also I told you. At present, say for example, on future contract of Turmeric. So turmeric at present on metric ton price is 8,000 rupees. You can assume. So we can't buy single metric ton. We can't buy single kg. So we can buy 5 metric ton. One lot size equal to 5 metric ton. So what about the price of today turmeric value? 1 metric ton price is 8,000 rupees. Okay, we can buy minimum one lot. One lot size is fixed by exchanges. How much? 1 metric ton 8,000 into 5 metric ton equal to 1 lot. 5 into 8,000, 40,000 rupees a total amount. But we should pay only initial margin, maybe 10% or maybe 15% or maybe 20%. Say for example, we should pay 20%. 20% how much? For 40,000? 40,000 at 20%, how much? Anyone tell me? 8,000 rupee. So we should pay the 8,000 rupee for initial margin. No need to pay 100% money for derivative products. If we are entering into future contract, we should pay only initial margin. Depending on the exchanges, it will be changed. So normally some exchanges charge 6%, some exchanges, some product for 10%, some product 20%, like that. Okay, so this is called future contract. So we are entering into future contract today. Okay, but we can going to, when will close according to the contract date. If you are entering into November 15th month contract future, you can buy today, you can sell before November 15th. So within the contract date, you can do transaction. So on transaction means one buying plus one selling equal to one transaction. So if you buy today, when will close? Before November 20th. Suppose if market is opposite reaction, market will come down, means we can enter into future contract for short position. You can enter into future contract for short position. I will let you know what is future and option okay, in upcoming slides. And I told you this underlying assets are like, especially for agriculture commodities, soya, chenna, cotton, gold, copper, wheat, or spices. Another example I am telling for gold. It is most of the investor aware about for gold. You can do for trading in gold through MCX also. Example, today 1 gram 24 karat gold price. I asked one basic question.
Sir?
The participants, yeah.
Hello?
Yeah.
Yes, sir.
Tell me.
Shruti here. Yeah. So just sorry to interrupt, but sir, we have time till 5:30, and
Okay.
I would
No issue.
request
No
if we
issue.
can focus majorly on the agri commodity
Yeah.
segment
Yes.
as to how they can
Yes.
enter into agri market
Yeah.
and what all
That.
commodities which
Yes.
are available in agri.
Yes. I am telling some examples, madam. No issue. Okay. So, say for example, agricultural commodities also we can enter. Say, you can assume today the cotton price is 1 kg at present 50 rupees. Per kg, how much? 50 rupees. Okay, you are assuming uh, before February 28th, the price will be uh, increased to 95 rupee. At present 50 rupee. Okay. Before 20th of February, it will reach to 95 rupee. What can we do? We can enter into long position. Now. So we can sell before 28th of February. Okay. And suppose the market price will come down. At present, the price is 50 rupee. Okay. At present, price is 50 rupee. But it will going to decrease before November 30th. Today date is October 13. November 30, before November 30, the price will reach to 40 rupee. What can we do? We can take for long position, not possible. Say for example, like short position, long position. If market going to bullish, going to increase the price of the particular commodity, we can buy today. Upcoming days we can sell. If market come down, today the price is 50 rupee. After 1 month, it will reach to 40 rupee per kg. We can sell today. We can buy after 1 month. So before the contract, we have to buy it. That is called short selling options available. So what are the role of exchanges happening means efficient price risk management platform. So risk management means minimize the risk. So and transparent mechanism and enhanced reach for physical market participants. Enhanced reach for physical market participants, price dissemination and efficient price discovery medium, diversification of portfolio. So portfolio is nothing but it is a combination of various assets. So it is going to diversify your portfolio. So that will be reduce the risk and minimize the loss and maximize the profit. That is the diversification of portfolio. Trade guarantee and transactional efficiency. We can say if you do for trading in commodity exchanges, so it is every how much quantity today by how much lots by what about the price, and you can see the contract note, and then for financial statement everything we can see. I will show you trading mechanism upcoming slides. And what are the products available in NCDX? Pulses and spices, oil and oil seed, gar complex, that is the gar seeded, gar gum, fibers, sweeteners and metals. Only I told you only one metals. Out of these 24 products are agriculture products, and indices also now 3 indices available. Agridex, AGRAD, Agridex, Gardex, Soyadex, 3D indices also available. Okay, same like that stock future, index future. Here also commodity futures, this commodity index futures also now available. Okay, and what are the features of contract specification? So before that, I'm going to tell about the feature and options. Feature contracts are the lot size will be fixed. Feature and option, both the contracts, the lot size will be fixed. Say for example, turmeric 1 lot equal to 5 metric ton, and another cotton 1 lot equal to 5 metric ton. So this is a lot size fixed. The market price will be differences. Okay, and the trade parameters. So basic centers and trading unit and delivery units, and basic trade unit means how much quantity, that is a lot size. Tick size, so tick size means the minimum price movement, 5 paise or 10 paise or 25 paise, like that. That is a tick size. And additional delivery centers. So the commodity, if you are enter into agriculture commodity contracts, you can take the delivery also. So initially we should pay the initial margin 10%. In between, sometimes market fluctuations will come, more volatility. That time we have to pay additional margin also. If you need delivery, before inform to your traders, commodity trading company, you can take the delivery also. And quality parameters, delivery specification they have to mention. Maturity date or due date, it is a last date of the contract. Say for example, November 30th is a contract date, means in between you can buy or sell. If you want to take delivery, the after maturity only you can take the delivery. Okay, these are all for trade parameters. And risk parameters are limit on open position. Open position is nothing but if you buy 10 quantity, 10 lots, sell 8 lots, how much pending? 2 lots are pending. Suppose if you buy 10 lots, sell 20 lots, so that also open position. The difference between buying contract and seller contract. So whatever it may be, that is called open position. Okay. Daily limit on price fluctuations. So per day, the exchanges also fix the limit. Normally 4%, 6%, 8%, they have to fix the limit. And margin, what are the margin we should pay as a trader? So basically we should know how to enter into commodity trading. It is a big question. Okay, I'm not forget about this initially. If you are trading in commodity, so first we should open a trading account with SEBI registered broking companies. SEBI registered broking company, you can open commodity trading account, and then you can pay initial margin. If sometimes we should pay extreme loss margin also, sometimes we should pay special margin and additional margin also. Why we going to pay for special margin or additional margin? Sometimes more fluctuations, more volatility. So that time we should pay for additional margin or special margin also. And finally, we can see the loss. Every day we can see MTM margin. Kindly note it. MTM means mark to market margin. Every day it will debit or credit. Say for example, yesterday if you are entered into a lot of turmeric, total value.
Is not moving.
The slide is not.
So your slide is not moving.
Now it's okay.
Yeah, now it. Yes, sir.
Okay. So, say for MTM, so you should know as a trader, we should know this MTM settlement also. Say for example, yesterday turmeric price is 1 metric ton price 8,000 rupee. Okay, on total value, how much we should pay? 40,000. Okay, but we should pay 20% margin. Okay, 8,000 already we paid. Okay, yesterday closing value 8,000 rupees. Yesterday now we are going to buy 8,000. You can okay. Today closing value 8,050 rupee. 50 rupees is called profit. That is called MTM profit. 1 metric ton 50 rupees. The price increase means how much MTM profit we can get? 50 into 5, 250 rupee. That is called MTM profit. If the price come down, yesterday closing value 8,000 rupee. Today closing value 7,900. We can lose 100 rupee for 1 metric ton. 5 metric ton, how much rupee loss? 500 rupee. That is called MTM loss. So this is called MTM settlement based on the daily closing price of the commodity. Okay. And final settlement or last date of the closing of contract. Last date. If you buy today, maybe if you are going to close on October 30th, so that time you can see the final settlement price. Okay. And overall participation in commodity derivatives and equity derivative, whatever it may be, speculators, hedgers, and arbitrage. Okay, say for example, speculators. So especially for speculators, were only for expecting short-term gain. So today morning the cotton price is 1 metric ton price is 5,000 rupee. So within evening it will reach 5,050. They are going to enter long position. So normally we are taken two positions for future contract, long position and short position. Long position means we can buy today, sell upcoming days. Short position we can sell today, buy upcoming days. Okay, this is we can understand. What about options? Options are nothing but the right to buy the obligation. Right to buy the obligations. Okay, two types of options available: call option and put option. Call options means right to buy, put option right to sell. So speculators are using this strategy. They enter, for example, if market is going to bull market, they can going to buy take long position of future contract, buy future contract or buy call option. Anyone they can do. If market come down means sell future contract or buy put option. Not go for sell put option. Okay, this is called speculators. So okay, and the hedgers means hedging is a risk minimization tool. Hedging is a risk minimization tool. So say for example, simple strategy. Upcoming slides I give some example for hedging. And hedging is a risk minimization tool. An arbitrager means arbitrage is a process of short-term gaining within the short span of that time, and buy one market or one place, sell another market or another place, that is another exchange. That is called arbitrages. So these three participants are participation in derivative market. And speculation, I told you, speculation means long position. What is long position? So if market going to bull market, so today you can assume the cotton price 1 kg is 50 rupee. So within a month before October 30th, it will reach 60 rupee. We can buy today, before 30th of October, we can sell. That is called long position. What about short position? Today the price is 50 rupee per kg. Okay, the price will come down before October 30th, 43 rupees. So what can we do? So we can sell today. How it's possible, sir? We don't have any product. How it's possible? How it sell? So it's available, possible for only future contract. We can sell today. You can buy before October 30th. You are predicted already. Market it will come. You have to predict it. So that time you have to buy it. That is called short position. Okay, that is called speculations. And spread trading. Spread is nothing but the difference between the two commodities or two contracts. Say for example, spread means 2-month contract available. Normally minimum 2 or 3 contract available for all the types of commodities. Okay, even turmeric or jute or cotton or pepper, whatever it may be. And this month price how much? Example, this month price of turmeric 1 metric ton 8,000 rupee for October 15th. November 15th contract price is 8,200 rupee. What about the different spread? 200 rupees. The discussed spread trading, that also doing for traders, not for hedging. Hedging is differ, speculation is differ. I will let you know the hedging strategy in next slides. Okay, so that simply I give only one example for long position. I told you the simple example. Yeah, you can see the ABC Limited. Okay, an exporter of gargum has entered into future contract. How much? Rupees 6,500 per quintal during June 2020. So you can see the price of this. The current future price of June 2020 experienced 6,400 per quintal. So they buy June future, how much? 6,400 per quintal. Okay, how much profit or loss we can see? Future price at present, how much in the exchanges? How much? 6,400. We are expecting this month. You can assume for October how much? 7,000 we are expecting. Okay, spot prices at present how much? 7,000 rupees. So how much we going to selling price? Okay, future selling price, spot prices of selling how much? 6,500. So how much we can get the profit of future? This is a future price. Buying price 6,400, selling price 7,000. Okay, how much profit we can get future contract? B minus A, 7,000 minus 6,400, we can get the profit of rupees 600. So we can get the profit of rupees 600. This is called future profit. Okay, if we are enter into spot market. Okay, spot market, how much the price? Buying price 700, selling price how much? 6,500. How much you can lose the money? 6,500 is the selling price. Buying price is 7,000. How much you can lose? Minus 500 rupees. Okay, so this is called spot market. You make losses. Okay, so suppose if you are enter into future contract, you can get 600 rupee profit. But if you are enter into you can having the product of spot market, you can lose 500 rupee. How much the overall profit? 600 minus 100, 500 plus 100 rupee only. So what I'm telling, so better this condition, what can we do? We can use it for hedging strategies. Hedging means we can go for simply an example I'm telling. If you are a farmer, you can assume today the price of turmeric at present 1 quintal 8,000 rupee. 1 quintal how much? Current spot market price is 8,000 rupee. Even though in future market NCD is also trading on 8,000 rupee. You are assuming you have 50 metric ton. How much? You have 50 metric ton spot market price in your warehouses. How much? 50 metric ton of turmeric. Okay. So what about the total value? 50 into 8,000 rupee, nearly 4 lakh rupee value you have turmeric. Okay. At present price 8,000 rupee. You are assuming before December 2021, it will reach to 10,000 rupee. Okay, you are kept it in your warehouse. Okay, waiting for increasing of prices. Unfortunately, November 10th, the market price will come down. It will come down to 7,600 rupee. Okay, at present 6,000. You are unfortunately November 10th. Kindly note it the date. November 10th, the price will come down to 7,600. Some of the experts are telling the turmeric price will reach to before November 30th. 7,000 rupee. What can you do if you have spot market? Okay, but already you think about at present price 8,000, but it price fall to 7,600. Again, it will come down to 7,000. So we can go for hedging strategy. We can go for short selling. Short selling options we can use. We can go for sell. We can go for short selling of turmeric contract. How 1 lot equal to 5 metric ton. We can go to sell 10 lots of turmeric. 10 lots of turmeric through NCDX. Why we are going to use for this kind of hedging strategy? So we're going to minimize our risk. We're going to minimize our risk. That's why we are going to use for the hedging strategies. And what are the indices? So at present, most of the traders are not aware about the indices, for especially for commodity indices. Equity indices, Nifty futures, stock, Sensex future. And we can see the Agri dates. This indices also available in NCDX. So we can see the Agri indices, how do they going to calculate the indices, it will going to increase or decrease. You know, Nifty based on top 50 companies based on the weighted average closing price. Here we can see what about the weightage of this Agri indices will be, it will going to positive or negative. The percentage of the contribution of soybean 16%, chenna 20%, RM seed 12%, gar seed 9%, castor seed 4%, liquid 11%, refined soya oil 13%, gargum 7%, jeera 5%, and turmeric 3%. These, based on these commodity prices, the Agridis index will be going to positive or negative, okay, based on weighted average closing price of the particular commodities, okay. And you can see this lot size. Yeah, you can see the Agridis lot size, same like Nifty indices. Okay, one lot equal to 500 units. Kindly note it. One lot equal to 500 units. One lot equal to 500 units, and settlement mechanism, cash settlement only, not for delivery. This is only for indices. Okay, maximum order size is 50 lots. Maximum order is, we can order place maximum 50 lots. One lot equal to 500 units. You can count it. Maximum 500 into 50, how much? Nearly 2,500. Okay, at the price quoted on per unit. Per unit example, per unit price is 50 rupees. You can assume. Okay. And tick size, the price movement is 0.25, and you can see the here due date, when we're going to close the contract date is last trading day of the month, and the trading time, kindly note it, Monday to Friday 9 a.m. to 9 p.m. we can enter into do for trading on agricultural commodity futures, Agridex we can do normal Monday to Friday, and at present, Monday to Friday, only 9 a.m. to 5 p.m. 5 p.m. will be indices are, markets are closed. Okay, but the last day it will be closed on every month of 5 p.m. it will be closed. And coming to this here, price limit. Yeah, kindly note it. That is very important. So this is regulated by SEBI. Per day price movement of Agridis indexes plus or minus 4%. Initially, it will ranges plus or minus 4%. After that, it will reach plus or minus 4%. After 15 minutes, market will be hard, and again it will increase to 2%. So this is called the basic for the price limit decreases or increases. And position limit, we can, so for 15% of total open interest in market in commodity indices. Yeah, coming to this margin, how much margin we should pay? So minimum initial margin should be paid 6%. So say for example, at present one unit price is, you can assume 50 means how much unit, one lot equal to 500. 500 into 50, how much? 25,000. We should pay only 6,000, 6%, 25,000 at 6%. We should pay the initial margin. That is called Agridex. And then and soya indices also available. That is called, we are telling about soya dix. So this is a tick size is 1 rupee, one lot equal to 100 units. This also market timing 9 a.m. to 9 p.m. But last expiry date is that time the market will be closed on 5 p.m. So the contract date specification available every month of last trading day, maybe 29 or 30 or 31 or 28 also. So that is the last trading day, and final settlement is every last day when we're going to close that time. And what about the minimum initial margin? 10%. I told you, if you enter into any derivative contract, we should pay minimum 6% margin, maximum 30-40 also, depending on the fluctuations of the commodities. Okay, and then Garex index also available. You can see the Garex index. Lot size is 1 lot equal 100 unit. Same timing. Lot size every month of last Thursday same. And minimum initial margin 10%. Okay, and why we going to enter into sectoral indices. Why we going to trade for enter into the contract of sectoral indices? Easy to trade. We can predict. So depending, I told you, depending on the commodity, if Garseed going to increase, means the Garseed indices also going to increase. Okay, but NCDX index generally today agri commodities prices are going to increase. So we can enter into agridix. So low transaction cost. Okay, and then facilitate arbitrage based trade also. It's available. Calendar spread trading available, and SEBI has not allowed the benefit in commodity index futures also. So that's why we are going to select for sectoral indices. And finally, coming to investor guidelines. Guidelines means what we do, what we don't do. It's like that. So what we do means read SEBI exchange circular available on the exchange website. All the information, publicly available information is available in SEBI website and NCDX website also. Trade only through exchange registered members. I told you initially. So don't open the account for unregistered broking companies. Okay. So you can open trading commodity trading account only SEBI registered broking companies. Okay. And fill KYC now. KYC means know your customer. So then only they will give you UCC, unique client code. Insist there on right and obligation and risk disclosure statement. We have to insist on bill contract notes for every settlement. So you know what is contract notes? Every day we can see the contract. So after trading hours, if you buy today 5 lots of 5 metric ton for 5 lots of turmeric. So after market hours, you can get SMS, and then maximum 24 hours you can get the contract note or bill through your stock commodity trading company. Ensure that the contract note contains all relevant informations like that member registration number, order details, trade number, trade rate. That is very, very important. Quantity, how much arbitration classes also you can see. And pay requirement, MTM margin. So example, MTM profit doesn't matter. It will be credited on your trading account. If MTM losses happen, means we should bear the MTM losses also. Our on risk assessment associate with the DABA trading. DABA trading is outside exchange trading. So try to avoid for this kind of trading also. And what don'ts, that is very, very important. What do we know? What don'ts we don't know, right? So don't deal with unregistered intermediaries, unregistered commodity trading companies, and don't understand off-market transaction. So don't undertake off-market transaction. So try to avoid off-market means outside the market. Okay, and then don't get carried away by alluring advertisements, rumors, hard tips, or any promises, any attractive tips. Try to avoid. Okay, if you want to ask help with how to do for trading, how to enter the position like that, SEBI registered investment advisors available. You can approach; they will guide you. Don't start trading before understanding risk disclosure classes. So first you should know the risk disclosure. So compared to spot market, derivatives are very, very high risk. So you should know the risk disclosure and don't accept unsigned duplicate contract notes. Don't fall prey to market rumors. Don't let risk against position accumulate beyond your capacity to bear. So, and don't simple go by any implicit promises made by analyst advisors experts, and don't miss on keeping track on your financial and contractual obligations against your positions. Don't go by the reports prediction made by various print and electronic media. So as a investor education trainer, my suggestion, so what we do first, we should know what we do not do first. We know initially on what we know, you should do it. Okay. So thank you for your past listening more than 1 hour. If you have any doubts, any clarification, feel free to ask me. You can come to chat box. And dear participants, if you have any doubts.
Yes, sir. So thank you so much for such an insightful session. It was indeed a pleasure for us to have you and explain us all those things. So now I would request our participants to write down any questions if they have in the chat box. We will be happy to answer all your queries and can guide you further to be a part of Agri Commodity Derivative segment.
Okay, madam. I'm going to add one more point. If you do trading in commodity, derivative or equity, whatever it may be, try to maintain the strict stop loss. If you are entering into position, it is a variable risk disclosure. So, for example, if you are entering into one lot of turmeric today, the price is 8,000 rupee. You are expecting for 5% profit within a month. Okay, but you can take risk also. Maximum you have to maintain the stop loss of 2.5%. If you expecting 5 rupee profit, you can take risk also 50% minimum 2.5%. Okay, so before going to enter into contract, you can decide. You have to fix the target of booking profit as well as maintain the strict stop loss only. Also, then only you can do trade continually. So it market, very well, it is more volatile. For risk also, we should pay only 10% margin, not for paid 100%, 50%. So maximum we have to pay initial margin of the commodity trading 10% to 30%, depending on the fluctuations of the commodities. Okay. Any other questions you can ask? Come to chat box. But especially for SF, agriculture background, you know very well about the crop cultivations, demand, supply. If more rain means the cultivations also very less and price will going to increase. So that time better we can enter into agriculture commodity trading. So you know very well, okay. You know the fundamental informations. Agriculture prices are based on the fundamental factor like agriculture monsoon and the demand and supply of the particular commodity prices. Based on that, it will going to increase or decrease. First, we should know the fundamental information, then only we can enter into the contracts for derivative contracts. Any questions? Especially for the future and options. At present, the NCDX 24 commodities are available. Out of 24 products also available in future contracts. Only 7 products available in option contract. Okay, only 7 products. You can see the websites. We can enter into put option or call option also only for 7 products, not for all the products. So what are the difference between future and options? Future contracts are high risk, high return. Option contracts are low risk, high return. In future contract, we should pay the initial margin. Option contract, we should pay only for premium. So maximum loss is premium only. But here, maximum loss is unlimited for future contract. But option contract, we should have to pay initial premium. That amount will be maximum loss. Okay, if you paid premium of 100 rupee per lot, one lot equal to 5 metric ton. So 5 into 100, 500 rupees if you are paying for premium for one lot of turmeric for option contract. If market come down, the maximum loss is only 500 rupee, but future is totally different. So how much price it will come down, that amount totally you have to make losses. Any other doubts? Yeah, Saram sir asking what we need to do, the enter into the marketing. So we are going to enter into marketing for agricultural product. Yes sir, no? Yes sir. Saram sir,
Yes, so for
you
this,
can
I would
unmute
like
and ask the
to
question.
answer.
Yeah, you can tell me, madam. You can tell me.
Yeah, so sir, basically here we are majorly talking about the commodity derivatives part, wherein you can understand about how you can participate in the commodity market, about marketing and everything. That is different subject we would talking about. not, then we would request you to kindly specify your question so that we can answer better way. But here in this session, in the discussion, we are about the commodity derivatives. Which commodities are as rightly said, we have 24 commodities. In fact, the price for price is impact on for the commodity season we had, what was the production, what was export, and all these factors will actually give the reference for the change in the prices of the goods. So that is what we are discussing here. But if you have anything specific, you may please unmute yourself and ask.
Thanks for your answer, madam. Dear participants, if you have any queries, you can send email to askus@ncdx.com. Also, you can go to visit the website. In future, not for today. In future, if you have any queries related to agricultural commodity trading and whatever it may be, you can send the email, and toll-free number also available. You can visit the website ncdx.com.
Yeah. So, sir, as we can see that we are not having any more questions from the participants. So let us. So we can wind up the session. So thank you so much, everyone, for your participation and listening to us. And I'm sure the session would have created an impact in your mind and made you understand about the commodity markets as a whole. So thank you so much, Dr. Prabhakaran, for your insightful insights on the commodity derivatives. So thank you so much, everyone. Have a nice evening ahead.
Yeah, thank you, participants, for kind patience and listening. And thank you, Sudhi madam, for giving the opportunity to me. Thank you, everyone. We can wind up the program, madam.
Yes, sir. Yes.
If any other formality, feedback form.
Sir, we'll discuss offline.
Okay. Thank you.
Okay.
Thank you, participants. Thank you, madam.